Before we get started, I want to thank the partners that have made the webinar possible today. Of course, we have Grant Thornton to thank, Air Canada, Canada Life, Cisco, the CWB Financial Group, Deloitte, Desjardins, the Export Development Corporation, Facebook, the Government of Canada, Johnson Insurance, Morneau Chappelle, RBC Rogers, Sun Life, and TELUS. So, the Canada Emergency Wage Subsidy is one of the federal COVID-19 support programs that has garnered the most interest and the most questions from businesses since it was introduced. First announced several weeks ago, and then finally actually up and running as of last week. So we're delighted to have John Di Liso, who's a tax partner at Grant Thornton, with us. John is going to provide an overview of the Canada Emergency Wage Subsidy, or the CEWS, as a lot of us are calling it these days, and the opportunities it offers to businesses. Then we'll discuss some of the questions John hears most often from his clients regarding the program, as well as what his answers to them are. We've only got 30 minutes today, so there won't be a live question and answer session. If you do have questions that remain unanswered after today's webinar, please submit them using the Slido app, along with your contact information, so that John and or one of his colleagues can follow up with you afterwards. So John, over to you.
Thanks, Susanna. Good morning, everybody. First, I'd like to take this opportunity to thank the Canadian Business Resilience Network and the Canadian Chamber of Commerce with the opportunity to spend time with you all today. As business owners and Canadian citizens, we are all operating in an uncertain world. Things are changing faster than we can keep up with. With that, Parliament passed the federal government's $73 billion Canadian Emergency Wage Subsidy legislation to help employers and employees cope with the COVID-19 pandemic. My objective for you today is to give you an overview of the program and to outline some of the key questions we have heard since the application process started on April the 27th. As you all may be aware, things are changing constantly, and we welcome you to use today's presentation as a reference guide, but please be aware that you should check directly with the Government of Canada's website for the most up-to-date details on program criteria and eligibility. The CEWS is definitely one of the most lucrative programs to support businesses that are struggling within the current business environment. The objective is to help businesses keep and return employees to their payroll. It should also be noted that it is a separate program from the previously announced temporary wage subsidy program, i.e. the program that allows up to 10% of employee wages to be subsidized through reduced withholding requirements. With reference to the program itself, there are a few noteworthy items to share. This support can be up to $847 per week per employee. This equates to 75% of a $58,700 annual salary paid weekly. The claim is calculated for each individual employee, not simply on gross payroll. Employers must pay the employee wages first, then apply for the subsidy. There is no overall limit to the subsidy claim, and employers are required to reapply each month, with each month being referred to as the qualifying period. So how does an eligible entity qualify for the CEWS? To qualify for the subsidy, an individual entity or an eligible entity must see a decrease in revenues in the current reference period as compared to a prior reference period. So for example, for the month of March 2020, it needs to see a decrease in revenues of at least 15% in comparison to a prior reference period. For the months of April and May 2020, the decrease in percentage must be 30%. When this program was originally introduced, the percentage reduction for the March 2020 qualifying period was originally set at 30%, but the federal government has subsequently adjusted the qualifying percentage to 15% to broaden the availability for individuals and businesses to qualify. So what is qualifying revenue? For purposes of the CEWS, generally qualifying revenues for either a prior or current period is based on the inflow of cash, receivables, or other consideration arising from sales or rendering of services or use by others of resources of the employer of an eligible entity in Canada. It is important that a qualifying entity use its normal accounting methods in the computation of its revenue when determining its revenue decline for each qualifying period. Specifically excluded from the computation of revenue are extraordinary items as well as revenues from non-arm's length persons or partnerships. There are special rules that deal with non-arm's length transactions that do give employers that earn income from related parties the opportunity to qualify based on a specific formula. Groups that are affiliated with each other may compute revenue on a consolidated basis, but if they do, they need to include revenues from all related entities and cannot be selective in the entities they choose to consolidate. There is a choice in the type of method in calculating revenue. It can be done on an accrual basis or alternatively on a cash basis. It is important to note, however, that once a method is chosen, that method must be used for all qualifying periods. Although the rules did not previously allow revenues from non-arm's length persons to be included, these rules have since been adjusted. Generally, an entity that has 90% of its revenues from one or more persons or partnerships that are from non-arm's length entities can factor in its non-arm's length revenues in determining its decrease in revenues from the prior reference period to the current reference period. All non-arm's length persons must jointly elect with the organization in order for this rule to apply. An organization that meets the criteria above would determine if it qualifies for the subsidy by factoring in the change in revenues of the non-arm's length persons from which it received its revenues, and that would be done on a pro rata basis. So this would allow, for example, an organization that has a centralized payroll company to potentially qualify for the subsidy, even if that payroll company only earned fees from non-arm's length companies. If the non-arm's length companies have suffered a decline in revenues as required, then the payroll company would likely qualify for the subsidy. There is a specific formula provided in the legislation that prorates the decline in revenues of each non-arm's length person or partnership. This decline in revenues is then applied to the eligible entity. The list of entities that are taxpayers that qualify for the CEWS includes a large list of individuals and entities. As you can see, employers of all sizes, whether they be individuals or sole proprietors, taxable corporations, registered charities and nonprofit organizations, other than public institutions, and partnerships with eligible employers, as well as other prescribed organizations. Specifically excluded from the eligibility for the CEWS are public institutions such as municipalities, local governments, crown corporations, public university, colleges, schools, hospitals, etc. So you'll notice on the attached chart, we've summarized the claim periods, the revenue decline percentages, and the reference period for eligibility. Each of the claim period, each applicant would assess its eligible remuneration for each period of time. Those periods are identified through March 15th to April 11th being period 1, April 12th to May 9th being period 2, and May 10th to June 6th being period 3. From a revenue decline perspective, each of the percentage decline in comparison to the prior year or prior reference period is outlined there. So for instance, there would be a 15% anticipated decline for the month of March in comparison to a prior year, and 30% for April and May in comparison to a prior reference period. When comparing to prior reference period, there is a choice in most instances. Typically, for instance, the March 2020 reference period would be evaluated based on a decline in revenue over a year-over-year basis, so in comparison to the month of March 2019. Or alternatively, if an election is made, to the average of revenues between January and February 2020. The same would apply for the April and May periods. So you'll notice that for the second method, the method of allocating or looking at revenues between comparing the current reference period to the average of January and February, that was brought in to address startups or those who did not have revenues in 2019. So some of the considerations that an eligible applicant would need to be wary of or should consider when they're doing their application is whether to use an entity by entity basis approach or a consolidated approach when comparing their revenues. Presumably the one that gives the best alternative would be the one chosen. In addition, there's a choice between using revenues on an accrual basis or on a cash basis. And again, the objective here presumably would be to maximize the claim that you would qualify for. The effect of revenues from related parties typically are excluded, but as I mentioned earlier, there is an opportunity for related parties to qualify based on a specific set of circumstances. And there also is a requirement that the amount of revenues be earned in Canada. Employers can also get a full refund of employer-paid portions of EI, CPP, QPP, and the Quebec Parental Insurance Plan premiums paid while employees are not working but are being paid. Also, nonprofit organizations and charities can choose whether or not to include government funding in their revenue test. The rules now state that if an employer qualified for the subsidy in a prior period, they will automatically qualify for the subsidy in the next period as well. So for example, if an employer that qualifies for the subsidy for March 2020 by meeting the minimum 15% revenue decrease, it would automatically qualify for the subsidy for April 2020, even if April's revenues only decreased by 15%. However, in order to qualify for the subsidy for May 2020, it would need to see a revenue decrease of at least 30% in April or May. So how is the actual subsidy calculated? It's based on a specific formula that's broken out into two buckets, and it's the greater of two amounts. So on the left part of the slide, you basically take a look at the remuneration that's currently paid and take 75% of that amount per week, with a maximum, compare that to a maximum of $847 per week. So the lesser of two amounts, compare that to the right side of the presentation or the slide, where you're taking a look at the amount of remuneration paid during that week, 75% of an employee's baseline or pre-crisis wages, and I'll get into what that means, and $847. So you take the least of those three amounts, compare it to the least of the amounts on the left-hand side, and it's the greater of those two amounts. So a little bit of a complicated formula. What you should note is, though, that the pre-crisis wages refer to the average weekly remuneration paid to an eligible employee between January 1st to March 15th, 2020 inclusive. However, if the employee was not paid for 7 or more consecutive days, this would not be factored into determining the average. The government has stated there's an expectation that employers will make their best effort to continue to pay the pre-crisis earnings to its employees. Finally, in a scenario where an employee is employed by more than one eligible entity that are non-arm's length to each other, the total amount of the subsidy is limited to what the subsidy would be equal to if it were paid by only one entity. So there is a special rule related to remuneration paid to an employee that is a non-arm's length to the employer. So for instance, the owner of an incorporated business or an owner-manager. This subtle change effectively prevents employers from claiming a subsidy on wages paid to non-arm's length employees who did not receive any remuneration in the period from January 1st to March the 15th, otherwise known as the baseline remuneration. If the non-arm's length employee did receive a wage during that period, the subsidy would still be limited to 75% of the baseline remuneration. This effectively prevents employers from receiving a greater subsidy if the non-arm's length employee's pay is increased after March 15th, 2020. So what is eligible remuneration? Eligible remuneration would include salary, wages, fees, commissions, and other taxable benefits. Excluded are retiring allowance and stock option benefits. Generally, eligible remuneration would include amounts from which the employer would be required to withhold tax on, regular pay, bonuses, and certain taxable benefits. It would also not include any amount received that can be reasonably expected to be paid or returned to the eligible employer at the discretion of the employer. Payments reasonably expected to be lower than the baseline remuneration after the claim period and other amounts intended to increase the amount of the subsidy would also not be eligible. So who qualifies as an employee? An eligible employee refers to an individual employed in Canada by the eligible entity during one of the claim periods noted below. It is important to note that any individual that does not receive remuneration in respect of 14 or more consecutive days in the qualifying period would not be considered an eligible employee, and thus the employer would not be able to claim the subsidy on any wages paid to that individual in that qualifying period. If an individual is either hired or rehired after being laid off in a qualifying period where they were not working for 14 consecutive days, they would not be eligible as well. However, if an employee is hired or rehired within the first 2 weeks or 14 days of a qualifying period, they would still be considered an eligible employee for purposes of receiving the subsidy. Therefore, an employer may need to take careful consideration of the timing of hiring or rehiring employees. So let's go through an example. In this specific example, this employee was laid off on April 30th, 2020. The individual would qualify for purposes of the wage subsidy for the period April 12th to May 9th for the weeks the employee is paid. And that's because he has not been without remuneration for more than 14 consecutive days in the period. Alternatively, if the employee is laid off on April 23rd, 2020, that employee does not qualify for the April 12th to the May 9th period because he or she has been without remuneration for 14 or more consecutive days. As such, an employer can hire previously laid off workers and pay them retroactively and still qualify. Here's another example of how the wage subsidy works. So let's assume for March 2019, the revenue of the organization or entity was $100,000. The average revenues for the January and February 2020 period is $120,000, and the March 2020 revenues are $90,000. If you compare the decrease in revenues from March 2020 to March 2019, the revenue only decreased by 10%. Recall, there's a 15% threshold. If the comparison is done to the January and February 2020 time period, the revenue decreased by 25%. So on the assumption that the average method is used for the January and February 2020 period, the eligible entity would qualify, and it would also qualify for the April period because it met the threshold. However, to qualify for the May period, both either the April or the May period results would have to show a decline in revenue of 30%. So how to apply? The application for the CEWS was made available on April 27th, 2020. The employer would first be required to pay its employees. After the employees are paid, the employer would apply for the CEWS through CRA's My Business Account portal. It should be noted that taxpayers are otherwise required to attest that the application is true and complete and not false or misleading. There's also a requirement that the employer will maintain records for CRA review and demonstrate the revenue reduction, employee remuneration, and other information to support the claim. The Canada Revenue Agency also provides employers the ability to sign up through Represent a Client for advisors to apply on behalf of their clients. And there's also a separate online web-based portal that can be used. The CEWS could be received through direct deposits for those employers that are set up for direct deposit. Generally, refunds are expected to be received within 10 days. If you're not set up through direct deposit, the likelihood is that you'll get a check in the mail, which obviously will take a little longer. And as you should all be aware that also, if you don't already know, so that the amount of the subsidy is taxable to the employer receiving the benefit. Now, if the employer receives a subsidy and is later found to not qualify for it or to qualify for a lesser amount, it will be required to repay the excess. If an employer has entered into an anti-avoidance transaction or a series of transactions that would reduce the qualifying revenues for the current period. A penalty of 25% of the subsidy could apply. And furthermore, if there's gross negligence issues, then a further penalty of 50% could also apply. So I'll go through some common questions now with reference to what we're seeing from our clients and provide an avenue for some of the current issues that we're going through. So Susanna, do you want to start that off?
Sure, John, thanks very much. So as you mentioned earlier in your presentation, the portal to apply for the CEWS opened last Monday, and we already know that thousands of businesses have applied for the subsidy. If a business hasn't applied yet, what would be your advice to them in terms of timing of when they should do so?
Well, it may seem like a very obvious answers, as those that need cash flows would presumably apply as soon as possible. However, if a taxpayer can support the cash flows of the business for a few months, they may be in a better position to ascertain which method would provide the most benefits. So, for example, given that electing for a particular method must be followed for all 3 qualifying periods, does it make sense to figure out which of the cash method or the accrual method yields the best outcome? Similarly, with the comparison period being either the month or the previous year, or the average of the revenues from January to February 2020, which one would be the most optimal? So those are some of the considerations that applicants should be wary of.
Okay, so definitely you have to consider several things before actually applying. Moving on to the issue of the revenue decline. What if my business is within the ballpark of the 30% or the 15% if we're talking about March, but not quite? What should the business keep in mind?
Well, it should be noted that any transactions entered into to defer revenue in a current period on the assumption that they will qualify in a subsequent period, or alternatively, if there's reduced prices that are being, for example, offered, which has a purpose to qualify for the wage subsidy, that could potentially lead to some negative consequences. A taxpayer is required to utilize its normal accounting practices to compute its revenue decline test, so whether that be ASPE or IFRS or US GAAP. So to the extent that the primary purpose of a transaction is to qualify for a respective period, so there would not only be a requirement to repay the amount, but there could also be some penalties for non-compliance.
Okay, so what about if I'm already participating in other programs? How do the other programs, like the 10% emergency wage subsidy that was available earlier, or the CERB, how do those programs come together, and to what degree can a business use them in addition to the CEWS?
So an employer may qualify, for instance, for both the CEWS program and also the 10% wage subsidy program. Unfortunately, employers cannot benefit from both programs. As an entity that qualifies for the 10% wage subsidy program, it must subtract the amount it's eligible for when it's applying for the CEWS subsidy that it is applying for.
Okay, and what about the issue of employees that aren't T4 payroll type employees, contractors? How do they factor in to the subsidy?
Yeah, so the CEWS program is intended to provide support for eligible employees of an eligible employer. So given that independent contractors are not considered as eligible employees, contractors would not qualify. However, on the assumption that an eligible employer hires a contractor as an employee, and on the assumption that the newly hired employee deals at arm's length with the employer, then the employer may be eligible to qualify in respect of remuneration paid to the newly hired employee.
And what about if I, as a business owner, don't pay myself through the payroll process, but I do so through the T5 dividend process? What are the implications there?
So sole proprietors may not take a salary in the course of providing their services, but they may have employees that help them with their business. So given that sole proprietors do not have eligible remuneration, they would not qualify for the CEWS subsidy. The sole proprietor, however, may qualify for the Canadian Emergency Response Benefit, or the CERB, for self-employed individuals who meet the eligible criteria of not working due to COVID-19 and can receive up to $2,000 per month. The sole proprietor may also qualify for his or her business carried on or employees on payroll on the assumption that the sole proprietor meets the 15% revenue reduction test, for example, for March, or the 30% reduction test for April or May, or they may automatically qualify for a subsequent period based on qualifying for a previous period.
Now, you talked a little bit about this before in your presentation, but how should businesses that have various divisions manage themselves in applying for the CEWS?
So, entities, some entities are more complex than others. Some have various subsidiaries and affiliated entities. And then there's an option whether to use a consolidated method approach or to use an entity by entity approach. And we're getting a common question as to whether you can change methods within the period. So the simple answer to this is yes, subject to a caveat. So if the accrual method is used for an affiliated group of entities for the revenue reduction test, and the consolidation method is used for March, for instance, then in the subsequent period, there is the availability to use an entity by entity basis for the April period. As such, a CEWS applicant is able to elect to determine qualifying revenue on a consolidated basis for their group of entities for one claim period, and be free to choose to determine qualifying revenue on a non-consolidated basis for all entities in a different claim period. The only caveat is that the eligible employer, if they're using the cash method to determine the revenue reduction test, if that method is used, then the consolidated or entity by entity method needs to be used consistently across all qualifying periods. So there's a little bit of flexibility there.
So what if I, based on the information that I have at hand, believe that I qualify for the CEWS, I apply for it, I receive it, and then I realize through new information that actually I didn't qualify? What are the next steps for me to keep myself out of trouble?
So to the extent that an eligible employer does not qualify for a qualifying period, the amount of the CEWS subsidy would otherwise need to be repaid for that period. If the eligible employer also automatically qualified for a subsequent period, it would also not qualify for that period unless it qualified for the respective revenue reduction test for that period. So for example, if an eligible employer did not qualify for the March 2020 period, it would have to pay back its March CEWS subsidy. And since it would have automatically qualified for the April period, it would also not qualify for that period unless it had a 30% revenue decline in April 2020. So just a bit of caution there.
And then I would have to reapply for May, is that correct? If I felt that I qualified?
That's right.
Okay. And so what are some of the areas that are still coming to you from your clients that need to be cleared up around the CEWS, some of the issues around it?
Yeah, so a common issue that is waiting clarification is the impact that acquisitions have on the revenue reduction test. So for example, eligible employers may find that they made an acquisition in June 2019, for example. When they're determining whether they qualify on the revenue reduction test, their current revenues for March 2020 onwards would include the revenue from the acquisition. However, when they're comparing it to the prior period, March 2019, the revenue amount at that time did not include the revenue from the acquisition, since the eligible employer did not own the entity at the time. So the CRA is aware of the issue and we're waiting for further details. There is the availability to use the average revenues for January or February 2020 as an alternative. So thanks, Susanna, for highlighting some of those questions. I would refer everyone, if you do have more questions, to some of the resources on the CRA has published on Canada.ca. They have a great list of frequently asked questions, and it's constantly being updated. I'd also direct you to our website, www.grantthornton.ca. We have a whole hub of information, not only on the CEWS subsidy, but a whole package on responses to COVID-19, all the government programs, and all the initiatives that are being put forward. We have a great COVID-19 business checklist. So what this is for those that are going through, some difficulties in the period and had issues perhaps with, whether it be financing, whether it be cash flows, whether it be cybersecurity, technology-related issues, HR issues. If they're looking for tax planning opportunities, we have a great checklist that served us, our clients, and also have great content not only for businesses, for employees, and also, as I mentioned earlier, a summary of all the government program information that we have available. If you have any further questions, I realize that you may have a lot of questions based on your own individual circumstances. We have a national team that's dedicated to helping our clients in these times. If you feel comfortable, please forward your questions to cewssupport@ca.gt.com. We'll make it a priority to get back to you. So with that, Susanna, I think that's it for me.
Great, thanks a lot, John. So thank you to everyone that took the time to participate today. We hope that you found it helpful. It was certainly a very, very thorough presentation on the program. If you do have any questions that are left unanswered, please use the Slido app and include your contact information. We'll provide that to Grant Thornton. It may not be John, but it will be one of his colleagues that will get back to you with an answer to your question. And this webinar has been recorded and will be posted on the Canadian Business Resilience Network website within the next couple of days. So the presentation will be there. And thank you very much, everyone, and stay well. Bye-bye.
Goodbye.